In the last lecture, while discussing about the economy and the industry level analysis, I had hinted at the concept of technical analysis. And even before, when I was discussing about efficient market hypothesis, I had discussed. You know that fundamental analysis involves the economy level analysis, industry level analysis, and company level analysis. So a company level analysis, I am postponing for now. I will take up after I have finished technical analysis, because that will not affect our understanding, and therefore I am just postponing and will take up differing for a few minutes. You know that technical analysis I will take up just to explain to you that there is other side of the security analysis. The other side. The other side, does not undertake any economy-wide analysis. What are the factors that affect the valuation of a share? What are the industry factors that affect the valuation? Rather, it tries to look at the history of the prices and try to find out some pattern by studying that. And it means that they believe in that history repeats itself. So it is like history repeats itself. Therefore, if we study the past prices, we can find some pattern. So what these technical analysts, also known as technicians, they do, they try to use graphs and charts, and then they look at the history of the prices, like they may depict the prices on a graph, time period, price, another maybe on volume. So they try to look at the price of a stock and over a period of time. And by looking at these graphs, they try to find out some pattern. And then they predict that stock price movement. And this acts as advice for them for purchasing and selling of buying and selling of a stock or holding a stock. So the idea behind, and these people are antithesis, they are on the other side of fundamental analysis. Entire course is based on fundamental analysis. But these people, they do not look at, these technicians, they do not look at, and they try to look at they say that whoever has undertaken fundamental analysis, like the company level, sector level, or macroeconomic data, they must have either bought the security, or they must have sold it, or they may have continued to hold that security. Therefore, if we study the price and volume of the security, we can find out the pattern. So those efforts have already been reflected in price, and therefore, it is based on a belief that stock prices move in trend. There are certain trends which can be determined. Now, because that technical analysis is not a science actually, therefore, if people look at the graph, different people, they may have different interpretation. That is unlike CAPM or other models. We do not have any agreed upon tools and techniques. There are a variety of tools, techniques used by them. So they point out that if we look at, we can find out some patterns. Some are the tools I will discuss with you today. So it is an attempt to identify a trend and maintain an investment until the weight indicate that trend will be reversed. Like you may have heard these terminologies by technical analysts. The stock is headed for correction, and then stock is like this. So what they say that the stock prices are like this, but there is a trend, there will be a trend in the future when it will rebound it and will correct itself. So these terminologies are the, so it is, some people say, but I hear the word science has been used, but not exactly, because you know that in your graph, you know, the volume I have already told you, and you are looking at the picture of something and try to find out a pattern. And because based on this thing, they undertake. This is what I have already explained to you. Market action or price discount the future. Whatever action. So market is a leading indicator. What people believe will happen is already reflected in buying and selling of shares. Whatever. So what people believe, they will either they will buy it or sell it or they will hold it. So that is why market tells in advance what lies ahead. And then they believe that history repeats itself. So because and they look at the human emotions of, like, from greed at peak to fear. That is why there are books written beyond greed and fear. When market is up, then all other people, they may continue to buy it because they think that they can reap the benefit of an upswing in the market. So, and it is human psychology, and they are driven by that. So what the technical analysis and try to understand is that these buying and selling patterns driven by these emotions is reflected in the transaction of the shares, and they try to depict it on a graph, and then they look at maybe upward trend is there, or like a graph I drew here, time period and price. Let us say it is daily or weekly or whatever. What they will do, that they will depict it. Let us say that they find that after 2 weeks the price have fallen, then again, or some other pattern are like this. So they will try to look at that after the downward movement, then there we find that there is upward trend. Or if they are having a graph like this, which is, although there are some decline, but upward trend is there. Overall, there is upward trend. So they try to look at these trend and try to predict the stock price movement, and they try to look at these trends. And please remember that the same graph may be interpreted by two people differently. So like how you interpret that data. So the father of the technical analysis is, you may have heard about Dow Jones Index. The father of the grandfather of rather technical analysis, trend analysis is Charles Dow, who established was Steel General. And you know that Dow Jones Index is also there. So what the Dow, he proposed a theory which is known as Dow theory. What this theory says that there are three forces. What he calls primary trend, which is a long-term trend, and it may last several years, from several months to several years. Then there are secondary movement or intermediate movement. See the underlying trend, and these deviations are via correction when price revert back, any maybe weekly or like that. So price correction takes place and the price revert back to long-term trend. And then there are minor trends, which are daily fluctuation, which are of little importance or significance. So he says that when we are depicting it, the price movement, we can find out the long-term trend, which is the primary trend. Secondary trend, there might be, the corrections the sometimes stock prices may go up and down, but it may move toward the long-term trend. And then there are fluctuations which are daily basis, and these are not significant, and one can ignore these daily fluctuations because you cannot draw a trend based on daily fluctuations. If you look at this graph, now a share price has been depicted here, is time period. You see that these are daily, these are primary trend, daily basis. And then over a period of time, these corrections, there are rise and fall, and like going on, the correction taking place. But you see that overall, there is upward trend. So these are the intermediate trend, rise and fall, the upward and downward movement. But you see that the overall tendency, the primary trend is that the stock prices are moving up. Again, there might be again a correction. So the primary trend is that if you see from here to here, so that stock prices have increased over this period. So one can detect that overall the tendency is the upward trend, minor corrections, and not is a standing minor correction and like that. So these are the minor trends, daily basis are like that, and these may be the weekly or for few months are like that, but they may not last long. So that is why the graph for each stock may look differently from that. Some you may find that there are downward trend like this instead of this the stock, and then you abrupt upward or downward. So no two graph of a stock will look different. The idea behind out here is that the stock prices move, there are trend in stock prices, and one can have the movement which are drawn from the daily fluctuations. But those are not important. What is important is the primary trend, the long-term trend, how the prices will move in the long run. So on that basis, one can predict that stock prices will move up over a certain period of time, or there is a tendency in stock prices to move. So this is Dow theory, the graph, and then these people, they also use some other tools. Like they look at relative strength. It is current ratio, current price to average long period. If let us say that current price is 200 and 6-month price, let us say 150, average of this 180, 190, 170, 150. So average is taken like 1, 2, 3, 4, 5, and this is divided by. So the greater this strength, how much is the stock relative? This is the average price of 5, 6 months. To divide by the average price, and the stock which have got highest relative strength will also be the stock that in the most recent period. And this suggests that if you buy this stock, you will reap. And if it is lower, I'm talking about relative. So if it means that the stock prices have gone down in value over the last 6 months relative to certain average, certain period, and therefore it may be not be good buy, rather one should sell it because the underlying tendency is that it will decline in value. Then moving average, that average, it. Moving average, that 52 weeks or certain, the consideration is given about the average prices. Like, let us take an example. Like this is Dow Jones Index. Okay. So what is done here is that if you are taking 5 week, 1, 2, 3, 4, 5. So here you will take the average. Okay. And then for this you will have start from here 2, 3, 4, 5. Then for this from here, it means that 5 previous weeks if it is accordingly. So that is the by moving average means that you take into account the average of 5 previous weeks accordingly, and or 52 weeks if you take it, then for 1 year average accordingly, the average will move. That is why the word moving is there. So this is how it is calculated. This also tells us about the tendency. If the stock prices moving average stock price is is higher relative to other, it means that a stock has a tendency to move up, and it may be a good bargain to buy. It may be good stock to buy. If the prices have gone down the average, then the last 52 average prices, then it may not. So this technique is also used by it. Then market, they also look at sentiments of the market. In your sentiments of the market can be gauged from number of puts. Puts is a call option, gives the right to sell. Right to sell. And if you are holding a put, then you are expecting to that you can sell it. Call means that you can buy. Usually what happens that when people are buying put, means that they think that stock prices, they are bearish. Stock prices will fall. And therefore, in order to safeguard, taking a type of insurance, they buy a put option. That if prices fall, they can sell at a certain price. And therefore, the put call ratio, if the ratio is higher, naturally, it means that market is a rise in put is a buy, mean that the market will go down, and you can buy now because you think that you can, when market there is a trend market upward trajectory, market is upward, then you can reap the benefit. But you know that this put and call parities is also used as a buy, and you know that in recent times, one more method is there, which we call volatility index. It is there, which is based on the volatility of various puts and calls, and that signals if the volatility index rises, that signals that market is, there is a fear in market. Fear with market means that market is bearish, that the prices will fall. The number of puts and the ratio also tells us about the sentiments prevailing in the market. If number of puts ratio going up, it signals that market is headed towards, so it's a fall in price. The market is headed in bearish phase. So this is also used by the. Then they also look at short interest. Let me just explain to you what I mean by short interest. There is a terminology which we call short selling. Actually, time is so short that when normally I take the financial market types of orders and others, and but because of paucity of time, these things could not be taken. Short selling, you know that the word selling, one can buy and sell a stock. Either using your fund, or if you're owning a stock, you can sell it. This is one way to transact. That if you own a stock, you can sell it, and you, by using money, you can buy it. In some cases, what happens that you do not own a stock. You are not the owner of the stock now. You do not own a stock. But you can get a privilege facility by which you can sell borrowed stock. You can borrow from a broker and sell it. And then after a certain period, for example, let us say 100 stocks are borrowed, from a broker XYZ stocks and sold. These stocks are sold, buying from, let us say, a broker. Now, after that period, let us say certain period, 1 week or whatever it is. So the person who has borrowed this stock from A will replace it. Replace means that it will provide 100 stock of the company, the same company. And why they undertake this thing? Because they undertake this type of transaction because they think that the prices of certain stocks will fall. Prices of certain stocks will fall. So therefore, what they do that they buy, they do not own the stock, but they borrow it from some other brokers and they sell it to, and so let us say that when they sell it, they are selling at 110 rupees, number of stock. So this amount they have received. Now they have to replace this stock and they think that the price will fall. So after the expiry of the borrowed period, let us say price is 100 rupees. Now what they will do that they will buy these stocks from the market and replace with the broker. So in the process, they have gained 10 rupees multiplied by the number of stocks. It may be the case that when they are going to buy this, the price may go up. But you know that in market for any transactions, there are two types of people. One who expect price to go up, another who expect price to go down based on whatever factor, based on their analysis, what we call the bullish, and another is called bearish. Otherwise, no trade will take place. So the short selling also tells us about the short, as they think that if there is a short interest is going up, then it means that the market is headed towards a bullish phase. Now prices are falling, will fall in near future, but it will rebound in the future. So now short selling is regulated by the stock exchanges, and in India, short selling was permitted before, but it was banned. Now it is permitted for only for not every stock, but few stock. And short selling, why it is advocated is that it will lead to better pricing. So it is like, that you sell a borrowed stock and you transact because you do not, what the stock market does that they ask for a margin, that if you are selling it, then that you have to keep a margin, let us say 20%. And during this period, that price, for example, let us say the price instead of 110, it has gone to 120, it has not fallen. So maybe the margin which has been kept may be wiped out. So there is a margin call also that you pay more. So normally 30% margin is asked for this thing to cover for the losses which may be there. So short selling is also one of the they use it to understand where market is headed. Then there is so many techniques of technical analysis, but I will not go in there, candlestick, this and that and so on. Interested people may go through those things. Now the question is that we have taken two viewpoints. One viewpoint is that market is efficient, stock prices reflects all the information, and the technical analysis which says that you can, and when market efficiency says that studying past prices will not pay because these are stale news. It has already been incorporated in stock price. If you read the history and try to understand the history, it will not pay you, and therefore there is no point in studying it. Whereas technical analysis is complete, the counterpoint of view. It says that stock prices, the history of the stock prices provide a lot of information, and therefore If we read the history, we can find out the trend, we can predict the stock price movement, and we can have investment strategy based on that. Now, as far as which side is, as far as sound, as far as the empirical evidence goes, we find that there is no unambiguous, clear-cut verdict about the effectiveness of TA. Like if you're looking at a picture or trend, there is a lot of subjective interpretation. And sometimes it happens that it pays, sometimes it does not pay. So therefore, their process is not scientific, it's very subjective. And therefore, we cannot say that the TA, that is technical analysis, has got the empirical support, strong empirical support. And you see that the human tendency, why we are, it is human tendency to see patterns. If you look at even the wall for a very long time, if you look at the cloud for a very long period of time, sometimes it feels that it is some human being, somebody is there, some images come to our mind like this. So if you look, so we are fooled, we see patterns, and we may be fooled by this pattern, which is randomness. And so we cannot draw any universal law from lines or graph, and financial market may be affected by, because if you are driving your decision, putting your decision on or on some line and graph chart and this and that, then there might be some event which may be like financial crisis, one-off event, where the maybe a large substantial portion of the stock prices may be wiped out, and no technical analyst can predict such kind of thing. But there are some pattern of return in stock market which defies market efficiency, which we call anomalies. Some patterns, there are some predictable patterns. So technical analysis is not altogether, ill-founded, their prediction, but there are some patterns, like stock which have performed well, which we call momentum stock. They continue to perform well for 3 to 4, and everybody knows this. It is not that it's some secret formula for investing. Yet the momentum continues. When any stock is performing well, they continue to perform. And then there is a long-term tendency of reversal. Stock which have not performed well in the recent past, then there is a reversal, which we call. So that is why there are two types of strategies. One is momentum, another is contrarian. Some people buy the momentum stock, and some people buy those stocks which have not performed well, in the hope that they will revert back after 1 year or more than 1 year. Then we also find that stocks which can be portfolio which can be formed on the basis of price earning ratio, size, or market capitalization. Also, for example, small stocks have performed, small capitalization stocks have performed better than the large capitalization stock. So what we call SMB factor, small minus big factor. It is small minus big means a small stock has provided greater return than the big stocks. So these are some of the challenges to market efficiency. But I said that technical analysis, since it is a very subjective thing, some of the tools like relative staying, short and put and all these things, but by the graphing and charting and like that, they are known as chartist technicians, and those who carry out fundamental, they are called fundamentalists. They look at this. So this is in very brief about technical analysis, with the counter viewpoint about the other viewpoint about the investing. And that there are, a school of thought which some people, they look at the trend only, they do not go for fundamental analysis. They think that those people who are involved in the processing, they are already have done it, and therefore their action is already reflected in buy and sell of the stocks. So this is in brief about market efficiency and technical analysis. If you have any question, you can ask before I go to introduce to you the recapitulation of financial statement which you have studied in the first year. Abdul Ahad, you are coming for the first time? Abdul Ahad, are you there? लॉग इन करके चले गए हैं क्या? नादिया खान?
Yes, sir.
Joining for the first time?
No, sir.
How many classes have you attended?
Sir, 5, 6 approx.
Okay. Aisha, what about you? Almost every class of January. Okay. Okay, so I have the attendance, but this I'm asking. So others like Jasmine Malhotra, Kavita Nair, Muhammad Danish. What about you, Danish?
Sir, I have attended, sir, 3 to 4 classes.
3 to 4 class. अच्छा.
Yes.
तो फैजान खान साहब कितनी क्लासेस? और अब आप तैयार रहिए, अगले बाकी सब क्लासेस में वीडियो में ऑन कराऊंगा, जिस खोलिया में है या है, समझ लीजिए आप. मोहम्मद साद, आप बताइए. इसका मतलब है रिस्पांस ही इतना शुद्ध आ रहा है, इतना तो लैग नहीं होता कि आवाज कहीं मार्क्स वगैरह पे जा रही है. यहाँ से लॉग इन करके चल दिए हैं. ठीक, इंटरेस्ट ही नहीं है पढ़ने लिखने में कुछ. बंद करते हैं इसको. मैं जाहिर सी बात है कि और इसको भी बहुत ज़्यादा मैं डिटेल में नहीं जाऊंगा, बहुत इसलिए कि टाइम नहीं है अभी. अच्छा, कल क्लास नहीं हो पाएगी आपकी क्योंकि कल बेसिकली फैकल्टी की मीटिंग है. तो कैसे मेरे पास अब 3 क्लासेस बची हुई हैं अगले वीक में, उसी में आज कल तक मोस्ट लाइकली फर्स्ट असाइनमेंट आपका मिल जाएगा. अब टेस्ट के लिए भी अगले वीक टेस्ट भी मिलूंगा, मैं बता दूंगा 1 दिन पहले. और क्या कितने यूनिट का होगा, क्या होगा ये बता. मिनिमम 3 यूनिट्स का तो होगा ही जो टेस्ट होगा. I have been discussing about the fundamental analysis and other things. आप ये बताइए कि आप लोगों ने फाइनेंशियल अकाउंटिंग पढ़ी है ना?
यस सर.
कितने तरह के स्टेटमेंट्स होते हैं? फाइनेंशियल स्टेटमेंट्स जो होते हैं कंपनी के कितने तरह के होते हैं? ओके, तो आज उसी को रिव्यू करते हैं कि क्या है, और लेटर ऑन जो है वो ये देखेंगे कि कुछ रेशियोज वगैरह को विच आर ड्राइव फ्रॉम दैट. तो ब्रीफली उसको रिकॉल करते हैं क्या है. ठीक है. कैश फ्लो स्टेटमेंट पढ़ा है आप लोगों ने? नहीं पढ़ा होगा, शायद पढ़ाते नहीं कैश फ्लो. 3 क्या बता रही थी आप? एक इनकम स्टेटमेंट हो गया, बैलेंस शीट, और क्या हुआ तीसरा? व्हाट वाज द थर्ड? कैश फ्लो पढ़ाया गया आपको? व्हाट इज योर बैकग्राउंड? आपने क्या किया है? ठीक है, चलिए कोई बात नहीं, कोई ऐसी कोई इशू नहीं है। देखिए, देयर आर 3 टाइप्स ऑफ फाइनेंशियल स्टेटमेंट, हाउ ए कंपनी presents its performance. The first is income statement. Income statement, provides the revenues adjusted for expenses for a specific period of time. Normally 1 year होता है, लेकिन इंडिया में क्या है, और देखो क्वार्टरली जो है वो परफॉर्मेंस that is to be reported. अभी इससे we will go one by one. Income, you can understand that. Second is the statement about the balance sheet. Balance sheet gives a snapshot picture. यानी कहीं फोटो ले लें किसी पॉइंट ऑफ टाइम पे, तो एक स्नैपशॉट पिक्चर देता है। इसमें ये व्हाट वी लुक एट प्रोवाइड्स इंफॉर्मेशन अबाउट कौन से एसेट्स ये, अगर स्टेटमेंट याद हो आपको कि कैसे हम, what are the sources of fund, how we raise fund and how we use funds, capital plus liabilities. Then there is a third type of statement which we know as cash flow. If you look at the word cash flow, we'll try to look at the cash flow generated during a particular period. The accounting rules provides that there is a concept of accrual. For instance, receivable hota hai. There is a receivable. You haven't received the cash now. Maybe the creditors will pay after 6 months. लेकिन you record in a financial statement. उसको आप इनकम की तरह मान लेते हैं कि भाई आप रिसीव करने वाले हैं एक तरह से एसेट में. So what we do in cash flow, we try to take into account how much cash has been received, or how much cash has been generated from the current operation, and how much cash has been generated from financing activities, and how much cash is there from the investing activities. So we look at that. So let us go in first with the balance sheet. Let us call it that sources of fund. ठीक है, इसको कहते हैं sources of funds. And how a company can raise funds. Okay. And asset, this side we can say uses of fund. How can it use it? Now there are various ways a fund can raise. The first thing, let us start with one can raise money by issuing common stock, equity stocks. One can raise money by floating bonds, long-term life. Plus, the company may have certain liabilities. Now, the current liabilities are less than 1 year that you have to pay, because you know that when you have a liability, you owe, you have to, and these are greater than 1 year. Like a bond आपने किया, debenture, you have to make a periodic interest payment. So same. So these are the ways, if you have taken some other kind of loan short term less than 1 year. So all these. So that is why these are the ways of company can raise funds. And this is also related to what we call capital structure. And how much debt equity mix. Modigliani-Miller hypothesis है ना, capital structure, how you how you are going to raise. I'll come back to this point later. Now, by raising the fund, what we do that, and retain earning, other thing, paid up capital, retain over the year profit which are accumulated. I'll discuss this thing later. Now, how a company uses this? First is that plant, machinery, other long-term assets may कर सकते हैं. And then they can also have to cash for running businesses. And the account receivable, for example, they may have sold some goods. They use this fund, and they may have inventory, unsold stock, raw material, other things, and they may have other current assets. They may have made investment in certain short term. So these are the sources from which a company can raise fund, and these are the sources from which a company. Now there was a concept of net working capital, which is nothing but the difference between current asset minus current liabilities. It means that in the short run, how much what is our liquidity position? If where our current assets are greater than the current liabilities, we'll come to that ratio later on. That may vary from. It does not mean that if a current asset is not up to the norm, a company will go bankrupt. The typical case. So these are the ways a company can, the obtain fund, and these are the ways company can raise the fund. Now it has got various implications when we look at the ratios. For example, when we look at about the liquidity of a company, I have already told you. For example, if you want to know that how much, for example, a company where this long-term debt is, what proportion is in the form of debt. Debt entails a fixed interest payment, whereas equity does not. Okay, so fixed interest payment is there. What type of company? For example, yesterday I was discussing about the financial leverage. The greater the fixed interest, that is debt, the greater that the company, if it is cyclical, if it is the performance varies according to business cycle, it will be very risky business. So, and moreover, the other ratios which are derived from this, for example, liquidity ratio is there. How good we are using our assets. What is the productivity and efficiency? So these will be used to understand later on some of these. Similarly, profitability ratios, which will come later from the income statement, and there is a linkage. All these things explained here. Current assets are that converted into cash, marketable securities if you make investment in money market instrument, inventories, raw material, work in progress, and finished goods. Other current assets, like prepaid expenses, you have already paid it, insurance and other. All these are included here. Long asset, I have already explained to you. And in long-term asset, depreciation charges are also taken because that asset wears out over the period of time it has to be paid. Please keep in mind that is the non-cash expenses. In what we will do, what is done in cash flow, that this depreciation charges are added because they does not result in cash outflow. So sometimes it happens that the goodwill are intangible asset. For example, if a company, normally this is a paradox, that a company may be having a very good will or reputation or brand name, but it will not be reflected in a balance sheet because these are intangible. But if you acquire some company, and for whatever amount you pay over and above, that will be recorded there. So in acquisition of a company, for example, Coke or any company taken over, for example, so that intangible asset is recorded there, whereas if a company does not require. Similarly, there are various amortization is there, like depreciation is for the wear and tear of the fixed assets. Similarly, brand name and other things may be written over a period of time because they decline in value. Again, this is a non-cash expenses. We adjust for it, but we do not pay. There is no actual cash expense. Now, the whatever value we write in the balance sheet, they are based on book value. Book value means that the historical, for example, a plant machinery or land, for example, if you record it at historical cost, it was purchased, let us say, in 2000. Its price in 2020 will be much higher. So its market price now will be much higher. That is why you see that when a company is acquired, that is why the investors also put higher value than the book value. Otherwise, the value of the share is 10 rupee or something like that. But so that is why. So but in the balance sheet we record the book value, not the market value, and this may differ over a period of time. Then liabilities are there, current liabilities, which is less than 1 year. Payable means that short-term debt you have, and salary another item which had to be paid but had not been paid. And I've already told you that difference between net working capital and the net current asset is net working capital. So it simply means that how much money we have for running our short-term operations. So long-term liabilities, I've already explained in balance sheet. The same thing you can look at the debt obligation. Capital lease is also lease payments are also, and any type of deferred taxes, they are also liabilities. So long-term liabilities that have to be paid. If they have not been paid, that will appear in the liability side of the balance sheet. And the current liabilities and long-term liabilities, the difference between firm's asset and liabilities is the book value of the equity. Now I'm coming to some other aspects. I will give it to you, the slides, you can read it. As I said that there are many things which are not captured in the balance sheet. It is based on historical cost, number one. Similarly, there are various, like some things are written here, like expertise of an employee, reputation in firm's reputation, customers' relationship with the firm, R&D. For example, R&D is taken as an expense in financial statement, whereas it pays R&D, if a company is investing in research and development over a period of time, it will lead to better performance of the company, maybe a new product and other things. So that is why these are all assets, but they are treated as expenses in the income statement you will see later on. So they do not get reflected in the balance sheets. So that is why when you are looking at the balance sheet, one should take into account that they are based on book value, they are not based on the market value. And that is why the investors, they put higher value than the book value, keeping in view all this. For example, a certain companies, like a pharmaceutical company is there for that matter, is investing heavily in R&D. So that is what are the growth potential of that company. So that is why it may differ from the industry to industry. We will take some example to understand this. Now the second type of financial statement is known as income statement. The word income, like you come across the terminology of bottom line, the last line in profit and loss. Like if you start with the sales, let us see here. For example, sales, how much a company has, the revenue has generated minus the cost of sales, raw material and direct, which is spent. So this is called gross profit. This tells us how much is the margin, profit margin, percentage of profit margin. average ratio also, the gross profit margin ratio, we divide by the profit divided by this, we get the how much. For example, some companies they have very high margins, some maybe have 2%, some may have 20%, some may have 30%. But this is not the entire cost. There are other costs like selling costs, marketing, general running for administrative costs, and other salary and other. You see here, research and development is taken as an expense here. And depreciation and amortization, these are non-cash flows that we add in the cash flow statement. But because machine has to be replaced, that is why we deduct it from here. All these. Once we deduct these further, then we arrive at what we call operating income. Other income may also company may have invested or something like that, so that may accrue. So we arrive at after when you add this thing, then we arrive at earning before, which is known as EBIT, earning before interest and taxes. And then we have to subtract tax income, interest income, and how much interest for the liabilities we have to pay, because the corporation tax rule provides that one can take allowances for the interest payment. So that is why interest income is as taken as an expense from here. And now we have arrived at the taxable income. On this, let us say 25% tax is there. I will take a concrete example. So after this, we get the net income, which is also known as earning. Now, if we divide by the earning of this by the number of outstanding shares, any number of shares, the total earning after this, 1 million share is there, divided by, it will give us earning per share, EPS. How much, what is the residual income to shareholders? Now, not the entire amount, maybe, so this is the income which is, and diluted earning actually means that, sometimes it happens that the companies, what they do, that they buy back the shares. So this denominator, the number of outstanding shares goes down. So, or they may issue additional stocks for that matter. The number of shares may increase. So that is why at different point of time, this may affect. But here the point, this is the last line, that is, which is called bottom line, the last line. Like people ask, what is the bottom line of your company? What is the net? So this is the income, which we call profit, net profit earning of the company. So this is how we are. Now these leads us to understand various things. For example, what is how much is the cost of the sales, that is the raw material and other cost which goes into the production of goods, plus how much is cost from these administrative costs and other things. So this gives us the operating income, and and then after we subtract this thing, then we arrive at the net income, which is the net. This is called earning for the company. Now, various ratios are derived from this thing, which we'll see later on, like interest income. Like if for example, this portion is very high as far as the earning is concerned, then it means that if this is very high, then a large amount of money is going for interest payment. So interest coverage ratios are there, other type of ratios are there. So we'll look at these. This is how the profit, the income statement. Income statement is very important in the sense that it tells us that the current operation of the company, and balance sheet actually record these happening, like but that is at one point of time. So, and if you see that there is a linkage between the balance sheet, and we'll see later on. Now, cash flow statement. We try to look at how much cash is generated in a particular period of time, quarterly. Normally, account is prepared for 1 year, but every company has to report uh, the quarterly performance, and that is available. So what we will do that I will in my next class I will take up the cash flow, and then we will take some real example to understand that how. After that I will take up some ratios introduced to you, and we'll look at some real life examples, and the how these we can interpret these things to understand, because you know that the whenever one investment is carried out, then what happens that the performance of the company can be looked what are the strength of a company, and that is why financial statement provides very important. For example, this information can be used to understand the performance of the firm over a period of time. This can be used for a comparison with other companies in the same industry. So, but we will look at these things in my next class. And I am not going that detail, because if I go in each and every detail of these, then it will become accounting class. Okay. If you have any question, you can ask before I close, and we'll meet you not tomorrow, but most likely next week. If there is some arrangement, some extra classes, I will inform you beforehand. Okay, we'll